All right. Hi, everybody. Thanks so much for joining us. Giving everybody just another minute while their audios connect. See quite a few of those that are still connecting. Glad to have you here tonight. My name is Misty Rusk. I'm the Executive Director of the Free Enterprise Institute here at University of San Diego. And this is the number 11. This is the last actual piece of content we're going to provide for the San Diego Angel Conference for Fund 4 with our party next week. So we're going to drop the link to register for the wrap-up event next week in the chat, probably a couple of times. But glad to be back with you tonight on probably one of the most critical things we've been building up to this whole season, which is on due diligence. So happy to do track number 11 of the E-Track series, session 11 on due diligence. As I mentioned, I'm with the Free Enterprise Institute at USD. We will be getting an update on that logo. So we had a family named the school last week, so we're now the Knaus School of Business at USD. Very excited about that. And the Free Enterprise Institute is one of 3 centers of excellence within the School of Business. And the Free Enterprise Institute is home to all the things that have to do with innovation and entrepreneurship at USD that are both student-facing, like you would expect, and also unusually community-facing. So we are the home of the Brink SBDC, which has 1,150 or 1,170 companies that have been part of that process over the last 4 years, and the San Diego Angel Conference, as well as our student-facing programs that are all under the umbrella of the Catalyzer. This is the screenshot from earlier today. Applications are actually due 1 week from today. This counter shuts off, I think, at the end of business, but we're going to let the applications go until 11:58 next week. Don't wait till the very last minute. It would be really great to have you get those in early so that you can come celebrate with us next week. So what's going to happen at the wrap up next week is we've invited the partners to come. We've invited a handful of angel and venture capitalists to join us. And we have invited all of the investors for SDAC 4 and our previous cycles as well to come and join us for the wrap up event as we kick off the investor track, which starts in January. All right, so if you click, I was showing you this is the screenshot of the website. If you go to bsdangels.com/apply, that's where you can find this apply button. And when you click on it, it's going to take you to Gust, which is the portfolio management tool that we use to manage our deals. Cost to apply is $149. Your application is not complete until you pay the $149. As a matter of fact, we can't see it until you pay the $149. So I've got a list of the companies that have already finished their applications. And after Will's presentation tonight, I'm going to stay on to help anybody sort out specific issues they're having in Gust. So happy to do that to make sure that if you are trying to apply, that we actually help make that happen. These are the companies that are currently listed as applying for the San Diego Angel Conference. That's just 10. So we had 125 last year, but we had about this many at 1 week to go. So I'm expecting that most of you have started applications, are in that process somewhere. But if you don't see your name here and you think you should, you need to reach out to me. And we couldn't bring this program to you without the help of some great sponsors and partners. Our sponsors this year include Nextwork. They're actually in the middle of rebranding, so we'll have an updated logo for them. They're now going to be under the brand V Teams as our title sponsor, and then our platinum sponsors, Mintz and ClearPoint Agency, and then our other sponsors, First Republic Bank and Queptis Law. And of course, the partners, click too fast. Of course, the partners that help bring this to you, there's a plethora of great organizations in the San Diego metro region to support startups like yours. So if you're not working with an accelerator, an incubator, or some kind of support organization, would really encourage you to reach out. And if you do any research and you find that any of these are a great fit, but you can't figure out how to get involved, reach out to us. So We work really closely with this group, and we're happy to help you make the introductions or help you do what you need to do to be able to get into the various programs that are available. All right, quick wrap up. So most of you are familiar with our process at this point. This is the last of the actual instructional part of the Entrepreneurs Track. Deadlines next week. Investors start looking at the deals on January the 5th. So if you feel rushed to get your application in on time, go ahead and get that submit, make the payment. You can keep working on it all the way through the end of our process, and then continue to use it with other investors as you go forward. But our process is going to wrap up Thursday, March the 24th with the finale. And with that, quickly, would love to give a shout out to our fund management team. I think Tammy is on the line, but not on video. And Brian Engelman's here as one of the fund managers. Brian, do you have anything you'd like to share?
I've just been typing in the chat a little bit, just a quick reminder on the applications. Yes, you need to have your first shot and the payment in by December 15th, but Gust, the platform that we use, allows you to continue to modify that. The investors will start looking at those on January 4th. So you probably want to have a pretty good set in there. You want to be really happy with your application. But of course, those teams that move on in the process, we actually expect you to be changing that because we want to hear the additional customers that you're getting or the additional IP that you're landing, et cetera. So it's an exciting time. I'm glad that you're all with us. Will's got some great content for us, and Misty, thanks again for everything that you do for the program.
And I would be remiss if I didn't give a shout out then to Chris, who actually helps keep us all on the rails. So appreciate all the work that he does to help us keep moving forward. I noticed Bianca Michelle is here. Bianca is with B Teams, and so I know she's splitting time between two events. So Bianca, if you would like, you're more than welcome to give a quick shout.
I mean, I'm not really sure what you've been discussing, or I know that you've been giving the little shout out here and there. But in essence, V Teams is essentially, we have about 500 remote engineers that small companies and then public traded companies use us to develop their apps or software. And right now we're working on some really incredible AI technologies that's going to be utilized hopefully come Q1, 2, that you guys might see on the news. So there's just a lot of cool and exciting stuff that we're doing and working with companies to develop these types of products with the ever-changing stuff that's happening in the landscape of technology. So yeah, it's a little bit about what V Teams does.
Perfect. Thanks, Bianca. And again, great to have you here. I'm also going to give out a shout to Diana Hanash Hags here tonight. She's been joining us every week for the series, and she has a very important role here at USD. So Diana, are you in a position where you could jump on and share for a minute? All right, she may not be in a place where she can chat. So we will go on. Our speaker tonight is one of my favorite speakers and one of my favorite guys. He's been my right hand on more than just the San Diego Angel Conference. He's helped put together every one of those funds. He actually gave some support to TCA when they set up the ACE fund. He and I have worked on a couple of different deals before I came to San Diego. And he's the guy who actually writes the check. That's the important part. This is the guy who's responsible for wiring the money to you at the end of the conference. He's our fund administrator. He runs a company called Signal Rock Capital. He's also the Associate State Director of Operations for the Idaho SBDC. And he's an angel investor and one of my all-around favorite speakers, but he does this great piece on due diligence. So glad to have Will Fowler with us tonight. And Will, I will hand it over to you.
Great, thank you. That is by the way, that is the most stressful part of my job is wiring the funds to the startup. It's like, you can have a typo in a document and fix it, but if you wire to the wrong account, that's a business killer. So anyway, so yes, I get to do that. I love doing that, but it's also super stressful. So I'm going to share my screen and tell me if you're seeing a big green slide. Are you seeing? Yes. Okay, good. Okay. Woo-hoo. All right. So so we're going to talk about due diligence, and I'm going to explain to you my perspective on due diligence for startups from an investor's standpoint. So what I'm going to talk to you about is some of what's going on with the investors that's important for you to understand. So when you get to due diligence, you have more context and you can go through it. There is no script for due diligence. I will give you the technical breakdown, absolutely. But every company is different and every relationship is different. And so we're going to talk about the ins and outs of what's important to investors. So then when you get there, you can be prepared to answer their questions and understand where they're coming from. So a little bit, let me see if this works here. A little bit about me. We talked about Signal Rock and the Idaho SBDC. So my experience, just to kind of set some context, is kind of all over the place. I have a lot of experience in startups. I really thought I was going to be a startup CEO. And then I realized how hard that was. And so I went back to the investing side of things. But I've got experience in operations and startups, fundraising. I've got a lot of experience on the investing side of things. I've got, my own portfolio of holdings. I have raised 5 member managed funds that are kind of not a conference model. Countless syndicates and SPVs, which are just kind of like mini single-use funds. I helped start the San Luis Obispo Central California Conference. That's something that Misty and I worked on together. The San Diego Angel Conference here, the Alaska Angel Conference. There's a new conference that I'm working on in Arizona called a Capital Gravity Conference. I ran 2 accelerators, incubators. And so that's my perspective. And everything I learned in Boise, Idaho. That's where I'm from, which is different than other places, but it's also kind of strangely applicable to everywhere else, because our issues with investors are distilled down to like the core form, because there's a smaller group. So that's my perspective. That's what I will be sharing with you. All right, due diligence for startups. So before we just get into what is due diligence, let's just do a quick context set, because the tension that I'm about to describe exists all the way through from meeting an investor to closing the check. And that is, there's a startup world and there's a perception of what that startup world is. So a lot of people view startups as people who think that they're rock stars. And actually, we want you to think that. We want startup CEOs to be delusional to a certain extent. You have to believe that something is true before it is, and then go out and make that. And the ability to execute on that vision is one of the things that makes you really, really successful and makes us a lot of money. And so it's not a bad thing, but this is how you view yourself. Other people don't necessarily view you that way. It's like, oh, you're an entrepreneur. That means that you don't have a job, right? So there's tension there between how you view yourself as a world changer and maybe how other people view you, and what it's really like. We all know this if we've been in it. What it's really like is it's a ton of work, and everybody has to be working together, investors included. And if one person's rowing in the wrong direction, the whole thing starts to spin around and it gets out of control. So that is the startup side of things. On the investor side of things, investors really believe that we are superheroes. We can come in and we can save the day. We can be the reason that you are successful. That's part of what motivates us, right? Is that we get to play that role in being a kingmaker or a queenmaker. So that's a lot of that is part of the self-perception of an investor. But a lot of times they're not viewed that way, right? By others, a lot of times they're viewed as an evil force or just in it for themselves and looking to sneak in secret terms that the entrepreneur didn't see. So when there is an exit, they get all the money. All those stories exist, and some of them might be true, but it plays into the perception and the tension between the startup world and the investor world. So imagine getting Darth Vader and Metallica in a room to close a deal. right? So that's the worst case scenario. And that's when you get to due diligence, what you don't want to have happen. So it's important, I just think, to set that context. So what it's really like though, for everybody, is it's a gamble, right? So investors investigate a return, and I'll share this slide with you in a second, but like most of the investments do not return anything. It is a total gamble. It's a super high risk gamble. And it's the same thing for the startups, the CEOs. It's a total gamble. And you sometimes put a lot more on the line than investors do. And if that gamble doesn't pay out, the consequences for you personally sometimes can be much greater. So it's also important to know that the level of risk for both parties is extremely high, because the most likely outcome is failure. The most likely outcome of any venture that starts for that team is failure. The most likely outcome for any investment that's made by an investor is fail. It's like 70% fail, like return less than the money that you put in. And so why do we do this, right? Because we're fools, we're just gamblers. We just want to invest in our hometown. No, we do it because we want a return. And that is the transaction that's happening when you go through due diligence. So you're accepting someone's money. They own part of your company and they expect a return. And that is the core transaction of what happens at the end of due diligence if things go well. We'll make money if there's an exit. So that's where 70% fail, because a company can be relatively successful, but not return any money to their investors. So the only way we as investors make money is to get a big return. And I think it's like 80% of our returns come from like 10% of our portfolio. So, 1 in 10 go big, and that's what pays for all the other 8 or 9 that return nothing. And so it's a super high risk asset class to be in. That being said, the returns can be really, really good, and due diligence is an important part of getting good returns for investors. All right, so an exit, we're going to go through some vocab. I'm going to say some stuff. If it's redundant, I apologize, but I always find it's good to let's just define what this means. Exit, right? That means that you get bought by Google or some other company or Apple, and they buy all the company, they buy all your shares, and they give you a price per share, and that's a lot more than it was when you took on investors, early on. And so then everybody makes money back, right? Because they get the market price for their share that Google gives you. And since I have 1% of your company, I get all that money back to me. So that's what an exit is. Here's just quick data: 70% fail or return less than 1x, 85%. So this data is a few years old, but it always is in these buckets. 85% of the returns come from less than 10% of the investments that we hold. The average ROI is 21%, which is pretty good. And the average cash on cash return is 2.5. So that's not bad. It just depends on how long it takes to get that 2.5. But it's not a bad place to be if you're an investor and you have the money to make multiple investments. I'm going to stop there. And I'm not sure how we're doing questions. I think maybe can you chat them in if you have questions? Chat is open here. Okay. Great. Here's a question. What's the difference between ROI and cash return? So ROI, return on investment, it factors in the time that the money was out. So I think the average harvest time, which is a terrible word, but the average harvest for the investments is somewhere between 5 and 7 years. And that slides up and down a year, just depending on kind of market factors. But the ROI takes into account that you made 10 investments, and on average, it took 5 years for them to start making returns to you. And so that money being out there, going to work for you for that long, gave you a 21% return. So that's what return on investment is. And then 2.5x cash, that's just pure cash. Doesn't take into account time. Okay. All right, I'm going to keep moving, but you guys can, you're free to type in questions as we go. And if I catch them, I'll answer them. But I have some stop gaps in here to stop for questions as well. Okay. stock. What is stock? This is some vocab. Stock are just shares of the company, and there's different kinds of stock, but basically, if you divide your company up into shares, and you could have whatever number you pick. It's in some ways it doesn't really matter, except you can get into trouble if you don't have enough. But it's just how you divide up your company, and it's what people buy. It's what the investors actually buy from you. Convertible note it's debt. It's taking out a loan from investors that converts. It's not like a loan that doesn't have a top. It converts to equity, to stock, based on certain triggers that are agreed upon by both parties. A SAFE is a simple agreement for future equity. It's kind of like a convertible note. It's just a little bit lighter and a little bit faster. Andreessen Horowitz made SAFEs very, very popular, and now they've kind of spread around the country. But they're really useful for when a startup needs money and will absolutely be raising a priced round quickly after they receive this money. So it's like the way it works for Andreessen Horowitz is they have their Y Combinator, and the graduating classes are raising money, and they just said, let's just make something easy for them, because we know they're all going to raise a price round quickly and have investments because they're coming out of Andreessen Horowitz. So they made this safe note that allows them to easily get money in, and it's relatively low risk for the investors because they know they're going to be raising money. However, it's become pretty popular, and it's not always used that way. So I have my own opinions about safes, but I'll save them. And here's why the vehicle, that's what I would call the vehicle for investment. Here's why that matters. It matters for investors whether or not they're buying stock in your company or they're giving you a loan, because we have tax exclusions. So because we're investing in something that's high risk, that's classified as small business stock, we can file a 1202 tax exclusions, which means that any capital gains we make, we get tax free. So if we put in $100,000 and make $1 million, we don't have to pay any taxes on that $900,000. It's hugely important to us, but you have to hold it for 5 years. And so when you buy stock, you're holding stock. When you buy a convertible note, it's not stock. The clock on the 1202 doesn't start ticking until that note converts into equity or converts into stock. And so that's why sometimes you've got investor groups who will push really hard for a price round, or who will push really hard on those triggers on a convertible note, because they want to make sure that clock starts ticking for them for 5 years, especially if you're a hot startup that thinks going to exit quickly. Right, so I just said that. Price rounds, like I guess this is kind of controversial, which I don't really get, but price rounds are better for investors. And sometimes they're better for startups, but there's a lot more that goes into those documents. They're more expensive because you've got to kind of figure out how you're going to create shares in your company and all that. But they're generally just better for investors. So if you get into a group that prefers priced rounds, no, that's why. They would much rather own something in your company, actually own it, than have debt, than have given you a loan. So the round, we talked about the vehicle, but the round, you probably already know this, but it's worth saying just in case, is the time in which you have valued your company and are selling part of your company. So it's like it's every time you decide to divvy up and sell part of your company, that's a round. And it's like seed, A, B, C, D, E, F, infinite. But that's essentially what that is. There are some numbers and standards around each of those rounds, and that are important to investors and that are important to startups, but you don't need to know that now. Like there's, like the Series D correlations and things like that. Like if you can make it to Series D, you have a higher likelihood of getting to an exit. There is some data out there, but for the most part, it's arbitrary. It's just when you decide to sell more of your company. We talked about the vehicle, and this is what's happening out there when people are investing across the nation. And again, these numbers slightly shift up and down. Probably there's this. I think this is a few years old, so probably there's a slightly more convertible notes than there used to be. but mostly out there, it is preferred stock that people are investing in. That may not be true in San Diego or in California in general, but if you take the nationwide numbers, most investors are investing in preferred stock. The reason I'm telling you this is so you know going in before you pitch the investors what their expectations might be and what that might mean for you. Okay, valuation. This is kind of like, I would say, like the biggest point of negotiation usually. And it's like, it's not too different than negotiating over a price of a car. The person who's selling the car wants to sell it for more money, and the person buying the car wants to buy it for less money. And the same thing is kind of happening when you're selling your company. And the valuation is how you get at how much of your company you're selling. So the more your company is worth, the less you have to sell for whatever money you need in your round. The lower your company is valued, the more you have to sell for the same money. I'll go through how that works. Okay, so there's a couple terms in here: pre-money, post-money. You've probably heard that, but let's just walk through what that means. Pre-money is how you value your company, and this is where all the negotiation happens, basically. Pre-money is the value of your company before you raise any capital. So when you pitch investors and you say, I think my company's worth $3 million, these numbers are arbitrary. We're just using them for this math exercise. It's worth $3 million. Or you say it's worth $4 million, and they say, no, it's worth $3 million. You say, okay, fine, $3 million. Okay, we're worth $3 million, pre-money. And then you raise $1 million, right? Your round, the round that you're raising of, let's say it's a priced round, preferred stock, you're raising $1 million. That means that your post-money valuation is basically the amount of money that you raised, in this case, $1 million, plus your pre-money valuation. You're already worth $3 million, and everybody agreed on that. And then you raise $1 million, so now you're worth $4 million, right? That's your post-money valuation. The way in which you calculate how much you have sold, or the way in which investors calculate how much of the company they own, is by taking the amount that they invested and dividing it by the post-money valuation. It's important to know that, because a lot of times you get caught up on the pre-money calculation, but you don't calculate ownership on pre-money, you calculate on post-money. So that means that if you raised $1 million and you were valued at 3 million pre, you're valued at 4 million post, you have sold now 25% of your company. And as an individual investor who might be writing a check, they will own, let's say it's $100,000 they invested, they will own 2.5%, because $100,000 divided by your post money, which is 4 million, is 2.5%. How this works for you is that if your company was worth $8 million, you would have sold a lot less of your company for $1 million. If your company was worth $2 million, you would have sold almost half of it. And so that's where that negotiation comes in. Investors are going to naturally want more. And where due diligence and negotiations break down is when it gets to be unreasonable and you can't find a middle ground. So investors coming in saying, no, you're only worth 2 million. And you're saying, I can't sell 50% of my company in my first round. It's unreasonable. You're going to get crammed down. Like we can't do that. And they're saying, nope, I want more. That's when it falls apart. And that's when things can get really ugly. So keeping in mind that the average out there is somewhere between 15 and 30% that companies are selling in their first round. Knowing that, take that with you and decide how much money you need to raise. And then decide kind of where you think you stack in your local competition. Like, how do you stack against other companies that have raised money from these groups, and go in with that? Because investors are going to say, well, we've made 10 investments just like this, and here's where they were in their development, and here's what their teams look like, and this is how we value them. So let's start there. And so if you can do some of that thinking and work ahead of time, you can come in with a price that you can still negotiate. You can still go a little high, but don't go 10% of your company if they're used to getting 20%, or 25%. That it creates it's harder to find a middle ground. So that's my thing on valuation. We could do a whole series on this. And here's why investors want more. Because we get diluted. And what diluted means is it's the amount to which your ownership as a CEO or a founder will be diluted, or the amount that your investors, their ownership is reduced by subsequent rounds, vehicles, and valuations. So if you value yourself at $3 million pre-money one round, and you value yourself at $20 million the next round, what that $100,000 becomes worth less, right? That $100,000 that you sold to that investor is not worth 2.5% anymore. It's worth a lot less because the company's valued a lot higher. And so this is where, when you get into due diligence, you'll have some anti-dilution rights and negotiations that investors will want. A lot of times at this stage, it's just first right of refusal to maintain their ownership. So like whatever it costs to increase my investment, so I still have 2.5%, I have the right to do that. That's a common negotiation point. Or it's just first right of refusal, or that we just get the same terms as whoever you're raising money from currently. So anyway, that's why dilution matters. Here's what it looks like. So let's use that same scenario. You're worth 3 pre, 4 post, and you received $1 million, or you received, like, let's take one investment for $100,000. The company then was acquired for 10x, right? Or almost 10x, $30 million. And however, it's taken a few rounds to get there. And so you've been diluted by 50%, which is a reasonable expectation for an investor who comes in early. And so you don't own 2.5% anymore. And so you only own 1.25%. And so the return is $375,000 on a $100,000 investment. It would be much nicer if we still had 2.5% on a $3 million exit, but that's how dilution works. It will happen, and we expect it to happen. But we want to make sure that there's some reasonable protections in there. Okay, I'm going to stop here. I see a few questions on the chat, and just going to give anybody a chance to type in and ask a question here on that stuff. Oh, somebody said first right of refusal on future rounds as a question. So I think I explained that, but a lot of investors like that term is that when you say you've raised the $1 million round, $4 million post money valuation, and then in 6 months' time you raise another round and you're valued at $10 million. First right of refusal means that the investors from that first round, you have to let them invest again if they want to maintain their ownership of 2.5%. So it might cost them an extra $100,000 to maintain their ownership at 2.5%, but it's a legal agreement that you have to let them. They have first right of refusal before you can go out and get like a VC to take the whole round. They're saying, no, the VC can't take the whole round because we want to have money in that round too, and we get the right to refuse it. That's what that means. Oh, and yeah, there's some good advice from Misty on Shark Tank. Definitely read that. Okay.
Well, there's a if I generalize the question, it has to do with how do you use shares to reward advisors or others that you want to be able to give something to before you have the cash that you can. Yeah,
you can do that. So that's part of creating your cap table. And so you can create a pool of shares. They have to come from somewhere though. So a lot of times the way that cap tables are set up, this is when you take the shares of the company and you kind of divvy them up. So when you start, it's like I own 100%. But if you start fundraising and bringing on employees and you want to carve out part of your company to give away, you're going to have to say, okay, well, instead of 100%, now I own 50%. And I'm going to sell 25%, and I'm going to keep the other 25% to give to employees or advisors or whatever. And that's how that cap table is formed. And you can use it to your discretion. A lot of times, I've heard this recommendation, don't take it for gospel, but I've heard a recommendation that you should carve out 30% of your ownership in your company for your employee option pool. And a lot of times I've heard it said that advisory boards or board of directors, while you maybe shouldn't be paying them cash if you're a young startup, you can give them 1% ownership in the company. And then there's a whole other whole other session we could do on how to do that and how to structure those shares so you don't get screwed. So you don't bring in a COO, give them 10% of your company, and then 6 months later, they decide, I don't like this anymore. I'm going to go to this other startup. And you just lost 10% of your company. So there's a way to structure that. So it's cliffed and it vests and all that stuff. But that's a standard practice. And you know, if you reach out to these groups, that, you know, they say the best way to raise money is to ask for advice, and the best way to get advice is to ask for money. So it's in the investor's best interest to help you if you want help for this stuff. And because they've seen a lot of deals, like going to TCA or going to the SDAC group and asking them, like, you know, what's your opinion on this? What have you seen? Is a great resource, because they're going to give you what they've seen in your local market. And angel investing, early stage investing, is largely a local activity. Yeah, so like, you know, like, I'm not going to say this is the right percentage to give out. One of the things is there's like, you know, is it this range? Yeah, I would just do some research on it. It's out there. You can find that information, but, you know, a percentage for a board director, I don't think is like uncommon. And advisory board members, you know, you have to be, advisory board is like, they're going to help you, they're going to advise you, but they don't have any fiduciary responsibility to the company. And so, you know, my advice, take it for what you're paying for it at the moment, is to be really careful about giving out shares to advisory board members. That a lot of times that's kind of marketing for you to get investors to say you have really good advisors. So, okay, I'm going to move on. Research where? Angel Cap Association, just Google it, Investopedia, local angel groups. I promise you this information is out there. Okay, really quickly, I'm going to run through this really fast. We can get into more due diligence stuff, even though everything we've been talking about relates to due diligence. Here's how investors deploy capital. There are a few different kinds of funds out there. There are passive funds. Think of a passive fund like a sidecar fund. A sidecar fund is formed when, let's say, TCA says you get 5 investors who put in $100,000, you get $500,000 from TCA. They might have a sidecar fund that says anytime 5 investors go in, this fund automatically kicks in the money to match them up to $500,000. And that would be a passive fund it's operating on triggers. There's no one really managing it. A managed fund is just the opposite. There's people in control. They're making qualitative decisions on how to place those investments and how to manage that fund. I would call an active fund, much like the SDAC group, which is the investors are also the decision makers, and they come together and they have a way in which they make decisions like voting and things like that. I think the TCA fund is that way, where they pooled their money together in a fund and they vote on how they deploy it. Call that a member managed fund. Then there's event funds, which are very similar. That's exactly what San Diego Angel Conference is. It's an event fund. It's a member managed or an active event fund. You could also have a managed event fund, but event fund is when they say, we don't know who we're going to invest in, but we know when we're going to invest. You've got groups and networks, like, I mean, there's a bunch in California. You know, TCA is the one that comes to mind because they've been around probably the longest. And then there's solo investors. So your due diligence will be different with each of those groups. So it's good to know, like, if it's a solo investor, they might have a totally different process. In fact, they probably do have a totally different process than a group like TCA or an active fund that might have, you know, a team that they assemble to come together and really dig into your stuff. So that's how they deploy capital. Process of investing is investors need to have the best deal flow. They need to have a process for screening that deal flow. So they need to understand, you know, when you've got all these deals coming in, how do I choose? What's my investment thesis? It could be stage, it could be industry, it could be anything, but they have to have a way to screen. And then there's due diligence. And that's essentially, I'll talk about exactly what it is, but it's kind of getting to the close. The close is writing the check. And there's a whole bunch of stuff that happens after the check, but we won't go into it. Deal flow, it's like, it starts with who do you know? And it's the same for you. If you want to get into deal flow, like going to events and networking and meeting investors is a really good thing to do. So you know where to go when you want to raise capital. You understand most people should be transparent about their screening criteria. So understand what their screening criteria is, and don't waste your time on funds or groups that are not going to be right for you when you're raising that round. They might be right for you later at some point, but focus on those groups that have criteria that match you. And then due diligence is an in-depth look at the company to validate the assumptions and the assertions of the company. This is so important to know, because their job is to validate what you told them, and to determine the major risk factors. Closing is negotiating, agreeing on terms. A lot of times closing is mixed into due diligence. And then when you actually close the deal, when you get the check from them, you have to issue them something. If it's a price round, they're gonna get a stock certificate from you. That's like a legal document that says Will Fowler owns 1.5%, which equals this many shares in, XYZ Snacktivist or whatever. So that's what happens. Okay, due diligence. Let's do it. Identify the risks, understand the team, and validate the assumptions and assertions. So I'm going to start from the bottom up. So when you pitch investors and you tell them all the reasons that you're a great investment, due diligence is the point in which they say, okay, we like what you've said. We're really interested. Now we're going to validate that what you said is true. And so you have to be very careful about what you say and what you allude to when you're talking to investors before you get to due diligence, because they're going to look at that stuff. They're going to call your customers and they're going to ask them if what you said is true. That's really, really important. Assumptions are what you predict to happen. Like, we assume this is going to happen. So they're going to look at that. And then the assertions are what you have said is true. Now, they want to understand the team, which is probably the most important part of a due diligence for the investors. Team. People are going to win, not their ideas. Ideas never win. People win, right? Business models win, and how those business models adapt. That's what makes you money. Ideas change. And then to identify the major risks to what you're putting out there. So the risks could come in any form, but it's important to know that they need to identify those risks, and you should help them. You should help them identify those risks, because it's not going to stop them from making an investment necessarily. They already know this is really risky. What they don't want is for you to hide a risk. And what they don't want is to go into an investment and have some massive risk out of the blue come to them that they weren't aware of, that was there the whole time. Like, new risks happen, right? But that's what they do not want. So help them identify the risks to their investment. It'll help you actually get to a close. Team. So why do they invest? How do they get to a yes? Team is probably the most important thing, in my opinion. And that's backed up by a lot of other investors, by the way. But team, who you are, how you represent yourself, how you recruit people. Do they believe in you? The grit that you have, that's what they're trying to get a sense for. And there's things that you can do during due diligence to help them. And I'll get into them, but show them your best self when you're going through this. The passion that you have, that's the grit. What they don't want is to spend money on somebody who's going to walk away. So they want you to be in it. They want to see your passion, your commitment to the project that you're on. And then there needs to be a return. If there's no return, they can't keep investing, right? So the upside potential. And a lot of times, well, most times, startups come in and the upside is way, way higher than it really is. And so, be okay with helping them understand what the upside is, and be okay if they don't agree with how high you think the upside is. And what do you want from them? You want them, number one, you want them to believe in you, right? You want them to give you your money and believe in you. It makes your life a lot easier if they believe you. They're supporting you, not questioning you on every turn. You want to give them a return. You want they want to believe in you. They want to get a return. They want to make an impact. And the last thing here, bragging rights, is actually really important. So I love it that I get to say a company I invested in exited, and I can call up the CEO because I'm on their cap table and they know me, and it feels like I know a celebrity kind of. That is a definite piece, psychological piece of what investors are after. So you want them to believe in you. You want them to take a huge risk. You're asking them to take a huge risk with their money and their time, because investors may spend a lot of time with you, helping you, opening up their network, all of those things after they make the investment. That's what you're asking of them. You're also asking them to like be patient, like just be patient, because these things don't happen overnight. And to focus on the end game. We're gonna make mistakes. We are wrong. We're gonna be wrong, but we're gonna keep moving, focus on the end game. We're gonna have a big exit in the end. That's what you're asking them to do. And the process of due diligence is sometimes just distilling it down to those things. Say like, look, I know I don't have all the answers, but you gotta trust me. And if you don't trust me, don't invest. Or, I know like you're questioning the business model. The truth is we don't know. We're gonna make mistakes, and you have to trust me to make those mistakes and focus on the end game. So that's where the conversation can go. Okay, when you're raising this round, when you're getting into due diligence, it's good to know if the person that you're dealing with, the group you're dealing with, is your lead investor or not. So what is a lead investor? A lead investor is somebody who comes in and puts in a significant amount of money to the round. Let's say you're raising $500,000. Maybe they put in $200,000. And they say, I'm going to put in $200,000, but I want to be the one that negotiates the terms of this round. So you say, okay, for $200,000, you can be the lead investor. And you should also say, since you're the lead investor, you help me raise the rest of this round. Because that's also kind of a responsibility they should have. However, what happens is they negotiate the terms with you. They set the terms. The terms are written in legal documents. And then anybody else who comes into that round after that, you've got $300,000 left to raise in that $500,000 round, right? So investors coming in, they're going to take the terms that were already negotiated by the lead investor. Unless somebody comes in, they want to put in 300 and they say, I don't like these terms, you need to change them. You need to decide as a founder whether or not you're going to go back to that lead investor and say, we're changing the terms, or you're going to tell that $300,000 investor to pound sand because I have my lead investor and these are the terms. So that's why being a lead investor is important, and you need to know who you're talking to. Because going through due diligence with somebody who's not a lead investor, there are things that they might ask for that you just say, those terms are set. We're not negotiating them, which in some cases makes it easier. And then this is just the question there, if you need to have an attorney, but also I've seen attorneys really blow up closings, turn a $5,000 closing into a $30,000 closing. So know that when you're talking to attorneys, what you're doing should be relatively simple. It should be templated. There are templated convertible notes out there. There are seed series terms that are widely accepted by most groups. And so getting into a red line war between two attorneys it's great for the attorneys, but it's probably bad for you, because the more it costs for you to close, the less investment money you're going to get to actually spend on your company. So I'm not saying go cheap, but I am saying make sure that you're not creating your own terms from scratch. Like start with templates that are already out there so it doesn't cost quite so much. And I think most reasonable attorneys understand that, especially at these early stage deals. Okay, are you ready? Here are the 5 steps to due diligence, the moment you've all been waiting for. Number 1, when you go through it, make sure that you focus on what's important. You're going to get asked a bunch of stuff. You're going to get challenged on a ton of stuff. And what they're trying to do is understand what you're doing. And so focus on what's important. Focus on showing them the team. Focus on the upside. So when they want to know about the team, show them the team. Like, let them come meet the team. And you can do your own internal exercises if you want to prep for it. But like, that's what they want to know. Can you execute? Can you adapt? The upside, make sure that they have all the materials you can give them, and work with them on understanding and maybe even changing what your market looks like and your business model looks like. Your business model may change throughout the due diligence process because you're bringing in some people who might know something about what you're doing that can help you. So focus on what's important, not on being right. Don't focus on being right, because when you focus on being right, it becomes positional, and that's a good way to end due diligence early. And then focus on the impact that you're creating. So when they're looking for impact, they're looking for traction, progress, and use of funds. What that means is traction is, what have you done so far? What traction can you show? This is hugely important, because ideas don't make money, and investors know that. Ideas don't make money. right? Business models make money, execution makes money. So if you can show them how you've executed, what traction you've created, and that can come in a lot of different forms. Sometimes it's just software development. Sometimes it's MOUs or promises to buy when the product is ready. There's lots of different ways you can show traction, but that's what you've done. You want to show them what you have done so far. Progress is like how you have managed your team and how fast you have gotten from where you started to where you are. And then use of funds is really focusing on the future. Like, what are you going to do with that money that's going to enable your company to scale and get to the next round? And so that's what they're looking for. So provide that stuff for them. And it comes, I wish I could give you a script, but I can't because it's different for every single company. Number two, which really is number one, is do not be an asshole. And here's the caveat. Don't be an asshole, even when they're being assholes, because they might be assholes to you. And they might not even know that they're being assholes, but they're being assholes, right? So know that when you're speaking to an investor, and I give this same presentation to investors, by the way, I say the exact same thing, because when they're an asshole, it kills their deal flow, right? Because startups talk to each other, and guess what? So do investors. So when you're dealing with your investors, when you're working with them through due diligence, you should treat it as if you're talking to every other investor in your market. Everything you say to them, imagine it being said to all the other investors in your market. Because the minute that you get positional and you get frustrated and you show that to them, and you become an asshole, you start behaving like one, they're gonna potentially stop, and they're gonna tell everyone else that you're an asshole. And I have to tell you, I have been the investor that has said, don't invest in this person, they're an asshole. Don't do it. Because number one, I can put my money in other places to nice people that will be just as successful as this person. But number two, I don't trust that person because they're an asshole. I know I've used that word a lot, so I'm sorry, but it's really important to know, remind yourself to calm down and not get positional when you go through this, because it can be very frustrating. And the reason that it's frustrating is because your baby is ugly and it's gonna die. You just have to know that going in. So they're gonna pick it apart. They are gonna pick apart your business model, and sometimes they're gonna pick it apart and they're gonna say, "Wow, that's great." And sometimes they're gonna pick it apart and they're gonna say, "You have made a massive mistake here." And it's okay for them to say that, and it's okay for you to accept that. If you've got your blinders on, if you're overly delusional, and they get a sense for that, and you're not coachable and you're not open to new information, then it's a real red flag for investment. So you have to know that no business plan survives first contact with customers. So if you have not had first contact with customers, true contact, it's going to change. And once you start scaling, it's going to change. It's going to change. You might get into a market that doesn't work. You've got to use your product and move to another market, and then it works. One of the investments that gave us a big return was a baby food company that put their food in the frozen food aisle. Well, that didn't work because nobody shops for baby food in the frozen food aisle. So they had to figure out how to get that customer in different ways, and had to reconfigure the product and all that. And they wound up selling for, hundreds of millions of dollars, which is great. So you will change many times before you exit. You know this because it's so helpful. You're not enough. Your vision is enough, but you can't do it by yourself. You can't build a massive successful startup and exit it for hundreds of millions of dollars by yourself. You can't. You need investors, you need a team. And that might mean at some point you're not the CEO anymore, or the COO, or whatever that is. That might mean at some point you're just on the board. And that happens a lot more than you'd think. So know that going in, because they may identify that as a risk. That has been a risk for us many times. We have said this person they can build the product, but they are not the CEO, and they don't need to go get a CEO right now. But we know that's a conversation we're going to have with them in the next 5 years. So know that it's okay, because the business is more important than your ego, right? Which is my next point. Who cares? Just be open, be coachable. Don't be like, don't blow around like a leaf in the wind, but don't be closed off to new ideas. And the most successful founders that I've seen go through tough due tough due diligences have been open to new information, but then have said, I hear what you're saying, but I'm not going to do it. And here's why. And based on my experience, based on the data that I have, it's not the right time to pull that lever or whatever it is. So you can disagree, but be respectful and open and tell them why. And if they want to dramatically change your business model and that's the reason that they're going to invest or not, that's probably not the right investor for you anyway. Okay. Step 4, get them, we've gone through terms, get them to understand your terms. You both really need to understand the terms of the deal. This can come back to bite you if you don't have clarity up front. So what kind of entity are you? Are you LLC? Are you C Corp? Sometimes that is a condition of closing. You have to be a C Corp. There are other investor groups who love to invest in LLCs. The vehicle that you're using, we talked about that. What's the advantage to them? What's the advantage to you? Finding a reasonable valuation, having reasonable anti-dilution. It's okay for them to not want to get diluted, just as long as it's not totally unreasonable. Whether or not it's going to be preferred stock or common stock if it's a price round. And preferred stock basically means that you get voting rights. You have some say in what's happening, and your stock is preferred in other ways. Like you might have other things attached to it, like information rights and things that you wouldn't have if you're common. Okay, and lastly, make it easy for them to go through due diligence. So this is what I mean. I'm about to show you a list of all the things that they might ask for, and there's probably even more than the list I'm going to show you. Be prepared and be responsive. So I have had this scenario happen so many times. We've gotten into due diligence, and I've asked for their last year's financials or something, and they go silent for a week and a half, and it's like, hey, did you get that request? Can I get those financial statements? And they're like, radio silence, and they're like, oh yeah, here they are. Well, obviously they didn't have them ready. They had to go find a CPA or somebody to create those financial records, and that's okay. But it's better to have it ready before you go into due diligence. Or if you don't have them ready, then tell them that you have to go create them. It's way better to be honest. So make it easy for them. The more information you have readily available, the faster you'll go, the more they'll trust you. It makes for a better relationship. So that's my 5th point, is to do your best to make it easy. And good investing groups are going to do their best to make it easy for you. So it's interesting because you're their customer. You're the investor's customer. You're how they make money, right? And the same is kind of true for you in this transaction. You're shopping for them too. But understand that if they're being overly onerous, remind them, that you're their customer. Like you should have alternatives. Okay, here's a big list. Here it is. Tax returns. Some of this stuff might make you throw up in your mouth a little bit if you have just started. And I know, I have a small company that I run, Signal Rock Capital, that is small in people. I like to think large in impact. But if somebody asked for my tax returns, I'd be like, oh man, got to go find those. Where are they? If they ask for my bookkeeping records, I'd be like, oh, geez, I had time to call the CPA and see if he could recreate something. So they will ask for this, though. This is a standard list. I've asked for this dozens of times, this exact list, what your pro forma is, what your financial model is, and the underlying assumptions in that financial model. If you don't have one, make one. That's going to be a big topic. A lot of times when you give your pitch deck, the thing that happens right after you're done is an investor raises their hand and be, oh, can you just go back to the financial slide, please? Right? It's just natural for them to want to dig into that. So have one of those made for you. You can if you're working with an SBDC consultant or advisor, they can help you create those. But there's also models for that out there you can Google. Your budget, how you're currently spending your money and tracking it. Your financial statements, your cash flow stuff, your cap table. So there's some questions that came in on how do I divvy up stock? So your cap table shows how your stock is divvied up. Have that ready to go. A detailed use of what you're going to do with that $1 million. And it's not a contract, right? But they want to know how you're thinking about it. And the financial model is wrong too. And they know that, right? Because you're imagining a future that doesn't exist, but they want to know how you're thinking about the money. How do you think about the money? And are you thinking about how your business model and financial model, develops over time? What thought have you put in there? Same thing with your detailed use of funds. This is often a friction point, a customer list and contact info. I've had startups say, absolutely not, you can't contact our customer. And we said, thank you very much. See you later. Best wishes. And it was okay. It was like, you're not willing to do that. And I understand, I'm not going to be a jerk about it, but that's a deal breaker for us. So just be ready to give that to them. And if you're going to raise capital, you should know you're going to go raise capital. And if you have customers, it's okay to actually tell them. If they're early adopters, it's okay to say, like, we're going to go raise capital. We're going to blow this thing up. It's going to be amazing. You might get a call from one of our investors, and I just want you to be honest. And so they expect the call. And we learn so much by talking to a customer that has worked with use the product or dealt with the CEO, because those early customers that you have are the ones that probably experience the most problems that you're reacting to and adapting to. And so they can be really, really valuable for investors. Your current org chart, even if it's just you, but you'd want to put in there what you're proposing after you raise your capital. All your team's bios. So write them out if you don't have them. Like a LinkedIn link doesn't really work. They're gonna look at that anyway, but they just have it ready for them. You know who these people are, why they're such a good fit for you, what their experience is, why they are reducing the risk of the investment. Your business plan. Not all investors ask for a business plan. So I don't like asking for business plans because I think they're antiquated for a startup, but some groups do. And then your offering terms, detailed offering terms. If you're working with a lead investor and you have no terms, that's okay. But at least go find terms to start with. Seed series terms. Just Google seed series terms or series seed standard terms. And they're out there. And there's the same thing like standard convertible note. Have something to start with, some basis to start with, so you're not just creating something from scratch. If you have all that stuff ready beforehand, it makes due diligence a lot faster. There's two likely outcomes that will happen after you make the investment, after the investors make the investment in you. One is that you'll go out of business. That's one of the most likely outcomes. Really, the only other alternative is that you're going to raise more money. And so know that when you're going through due diligence and building these relationships, your best source of capital for your next round are the investors in your current round. And so I guess the major message that I'm trying to deliver here is due diligence is a relationship building exercise. It is also a technical exercise. And so expect them to come to the office, expect them to meet your team, expect them to call your mom, whatever that is. But it's all in the name of creating a long-term relationship. They're going to be in it with you until you go out of business or sell the company, because they're going to be owners in the company. And so know that the result of this should be a workable relationship. Okay, that is the end of all of my information, I believe. Let me just double check. Yeah. So any questions? I'm going to bring this over so I can take a look at it. Any questions based on anything? Okay, so here's, I'm just going to start from the bottom up. My online business went live a few months ago, no revenue, no paying customers, 2 enthusiastic reviewers, team of 1, the founder, invested 10,000 hours in software development, complex, not easily describable in 3-minute pitch. What's likely an investor would be interested at this stage? 0, unless you can have a describable 3-minute pitch. That's the work. If it's when I hear a company come in and pitch me and they talk about the 10 years they spent developing this product, I immediately get skeptical, because what I want is contact with customer contact. And so finding a way to distill that down to 1 or 3 minutes is your work. Once you can do that, you just got to practice. Once you can do that, then there's not anything there that would make me uninterested, except for the fact that you can't describe it. Okay, what common stock is voting rights preferred generally does not. Somebody's maybe clarifying something that I said. That depends. So in a round, If terms are changed, if you have preferred stock, you have to vote to approve that. If you have preferred stock, you have to vote to approve the sale of the company in the end. So there are some things like that that happen that I do not believe happen if you have common stock, but there are people who probably know more about that distinction than I do. What kinds of investors are interested in C Corps and which in LLCs generally, and why? So I would say most investors are interested in C Corps. And the reason is a C Corp is designed to have corporate shares as its own, it's taxed as its own entity. And so the corporation pays the taxes, the corporation handles all of that stuff, and it doesn't flow through to investors. LLCs are flow throughs. And so the reason that people don't want to invest in LLCs is that if you owe taxes, that's going to, a lot of times, like I might have phantom income. You might have made a profit one year, but I didn't get any money for it as an LLC owner, but I still have to pay, I have to pay taxes on it. The reason that some investing groups like investing in LLCs is just that reason. One of the wealthiest investors I know is a founder of pop sockets, those little things that go on the back of cell phones, little poppy things. It's an LLC, and he gets like a massive distribution every year. So he doesn't care about taxes because he gets plenty to pay for that. So that's the reason. It depends on what they're looking for and the business model. There are angels. I think there's a group, I heard them speak in Houston, that like exclusively does LLCs, but it's I would say it's more on the fringe, becoming more popular, but more on the fringe. Okay, let me scroll on the bottom here. Are seed round investors usually more interested in the viability of an idea? I think, to each their own. I can tell you, I'll give you a general answer to that. Seed round, nobody is really interested in an idea. So it's really hard to get money for something that you have created in your head. It's a lot easier to get money that something you've created in the real world that's been validated by customers in some way. And so it's not that you can't get investment, but that's what they're going to be pushing you towards anyway. So the kind of investment that you get at an idea stage is going to be pretty small. I would go family and friends there first, and then build something. A demonstratable product is usually a criteria for investment. So, I mean, the viability of the idea is the product. Oh, can you describe more what you mean by go positional? Yeah. Thank you. That's like a Willism. So when I said don't get positional, so what I mean is when you're in a negotiation and you say, this is my position and I'm not moving from it, and they say, this is my position and I'm not moving from it, you are effectively stuck, right? And then it's just a battle of wills, and not this will. Like it's a battle of like it's chicken, right? And you want to avoid, in my opinion, you want to avoid that at all costs. Don't get positional. And if they're getting positional, you can let them know in a nice way, a respectful way, to try to move past it and ask them, is this going to be a deal breaker for you, or can you move past this? And so that's what I mean. Is that when you get positional, you get stuck. Okay. Any other questions? I'm sure I'm probably like way over time, Misty.
You're fine. It's a great piece, and we totally appreciate having you. And we'll keep you around for another round of Q&As for people who want to ask you more specific things in a breakout room. If you have,
you bet. Yeah.
We've got that coming up. I do have let's see if I can do this. I do have a quick share.
Well, let me unshare. If you guys feel free to reach out to me at will@signalrockcapital.com.
Yeah, so please put your like little hands together for Will. It's always good to have him with us. I'm sharing there on the screen. Hopefully you can see my screen because it doesn't look like it's sharing, but I think it is.
Yeah, it is.
This is the vault master that we will use for SDAC 4. So basically what we do is we create these 4 folders, and then there's a questionnaire that goes out, and this is the same questionnaire that TCA uses. We match them up on purpose so that if you end up applying to them and you've been through our process, it makes it easy for us to share the deal and cover all the bases. But that questionnaire has all the questions that we're going to ask of all of the finalist companies that go through our process. And then there's a couple of other things. Sorry, my stuff is really slow to load. So it has like basically, pages of things to have you answer. And then And then we have a list of categories. So the category list is ours. These are the documents you're likely to get asked. As a early stage startup, you probably don't have a lot of these. It's totally fine. But we put them out there so that we've got a way to filter for them. So try and share this pretty often as you're putting your documents together. If you're listing and naming them this way, it makes it easier and easier for investors to navigate and get through them quickly. And then we also prescribe a naming convention. So our naming convention is that set of codes from that last sheet that I just showed you, the title of the document, the name of your company, and the date. And that gives us, like, the more companies that use this kind of format, the quicker investors can get through. We want them to spend as little time. We want them to do the meat of the due diligence, not be looking for the documents. So I'm putting the link to that. So the link to that whole folder is in the chat. But it's also on the website. So if you go to the sdangels.com/events and you scroll down to the due diligence thing, there's a link there for materials, and that vault folder is there as well.
This is awesome, Missy. And I would just say to everyone, like, this is an example of a very well vetted due diligence process that might be different for another group. Right. So, but I haven't ever seen a list as big as that one. So, like, if you use the TCA list for sure, all that stuff, if you have all that stuff ready, or an explanation of where it is or why you don't have it, then you'll be ready for any group due diligence, because that's pretty intense. But it might be different depending on which group you're going through. But that's a really good asset.
Right. Definitely different. Most groups are going to be less than that. So that's a pretty exhaustive list. For our purposes, when we share it, we say, you know, I don't know as a financer, or I don't have it. I don't have it's a financer for early stage companies. So the more advanced you are, the easier those things will be. And as your company grows, you're going to have a lot of these things anyway. You might as well just store them here to begin with. And then it's not a big deal when you start into the due diligence process, because you've already got it gathered up, because you've gathered it as you've gone along. So, so if you're playing around in that vault, you'll see that you can see things, but you can't edit or change anything there. Feel free to download anything there or copy those folders over. Use that however you'd like, but it's intentionally, that's our master. So actually it's a copy of our master, but still, I don't want you to tinker with it. So I want people to be able to continue to see what we share. So other questions for Will before we go to breakout rooms? There's a question that says, what's TCA? TCA is the Tech Coast Angels. So there are a number of chapters around mostly the Western United States. The one that nationally syndicates is in Irvine. The biggest chapters here in San Diego. So we've got a real powerful investment, and it's a member managed fund. They have a member managed fund, and they also have the ACE fund. So, Tammy, sorry, did you have a question? Or are we going to share something?
No, did I go off mute? I'm sorry.
Thought that might be the case. So just double checking. All right. Chris, you want to go ahead and move us to breakouts?
Sure thing. I'm about to open the rooms. You're about to get kicked out automatically to your Gust applications room. Then there's Will, SDAC General with Brian Engelman, and then next work, has Bianca left us?
Bianca's still here. We have a room for V-teams, but if she's not, we'll catch her next time.
Okay, yeah, I had her assigned. I'm not seeing her, so enter at your own risk. I'm about to open the rooms, and you know the drill on how to get there. If you're having any troubles, just let me know and I can get you to the right room.
Staying on. Are there any parting questions or any pressing things? A couple of quick things to share. So one of the questions that came up in the room where we were talking about the GUST application was about the video. Yes, please stay as close to 60 seconds as possible. That's important. We ask every investor to review every video in the first week before we get together for our first set of meetings. And so if anybody's going like 2 minutes, 3 minutes, 5 minutes, we go from 100 minutes of videos to far too many for people to review. So please try and keep that to a minute. Production values don't have to be great. This is really just a way for us to get to know you a little bit. And then the other thing is probably in the application, if you don't put in all the social media handles, you'll get stuck in the application. That happened last year. I'd forgotten about that. Somebody brought it up. If let's say you don't have an Instagram account or you don't have Twitter or Facebook, it is fine to use the Free Enterprise Institute's handles. And then that just tells the investors you don't have it, right? So no need to go create social media sites to be able to complete our application. That's not necessary. But you can use those. You can use our social media handles to meet that criteria. And that's a good indicator. Like then we all just know like, oh, they don't have that.
I wanted to share something with the whole group, Misty.
Okay.
Last time when we were here, I asked a question, does it help to fill out the application form early? And you said, yeah, it has some benefits. So what I did was I filled out almost entirely except for the video part. And I'm getting accelerators from Israel asking me to participate in their accelerator program. So because I think they also share GUST. And so they see my profile and say, do you want to participate in our accelerator? So it's kind of working great,
That's good to know.
Yep.
For the rest of you, you can set the parameters on who can see your deal. So we want to make sure that when I should actually share this. So I put the social media handles in. Let me go to the public profile for 4. You definitely want to make sure that you get your deal assigned to our portal. But you can leave it open so that any investors can see your deal. There are a lot of investors and investor groups that use this platform. So, but you have a lot of, as the principal, you have a lot of say over who can see what on your application. The link that I dropped in the chat, that's the public facing, if you go to our website and click the apply button, it takes you right to this page, but you want to make sure that at the top, what you see is SDAC 4, Roman numeral 4. Any other questions for tonight? All right, 7 days, ladies and gentlemen. It's a great, fantastic, this has been a fun thing and miss getting to see everybody in person all the time, but so grateful that we can meet with each other this way, and really excited for what's going to happen starting in January as we move from planning into like actually executing the angel conference. So very excited. Any parting thoughts or words of wisdom, Will or Brian?
No, go apply and we'll see you all hopefully next week for the celebration.
Yeah, celebrate your no's and celebrate your failures. As long as you keep, that's my advice. Just keep moving. You learn something every time.